Is corporate credit a, quote, tinderbox waiting to explode? Even some on Wall Street are beginning to worry about how narrow spreads have become. Yes, narrow. The level of complacency is at an extreme. We haven't seen some of these spreads this low since 2007, right before the global not financial crisis. And in one case, they haven't been this narrow since 1998, just prior to the Asian not financial crisis. Basically, the entire credit market is demanding historically little additional compensation for taking on some pretty serious risks. The reason is simple complacency, the idea that nothing has gone wrong, so nothing will. But that's not really a completely accurate description. Instead, everyone knows spreads are way too tight. So what all of Wall Street is waiting for is a specific trigger or set of triggers to unload everything. The entire industry knows it's holding a tiger by its ears, and it'll only let go under certain conditions, those which display specific signals. Until those show up, everyone will hold their noses, hold their breath, and pick up less and less return for risks that are not being priced like they should. Again, everyone knows it, which is what really happened last August. It wasn't so much of the carry trade blowing up as it was fear those signals everybody's on the lookout for, maybe they were starting to emerge. And now here in early 2025, some of those are starting to come back into view just in time for these ultra low spreads. The latest economic data from a variety of sources indicate a dramatic loss of momentum of the U.S. economy. After a minor positive bump to end last year, a whole lot of data is now rolling right over and pretty quickly. And if it is, then historically low credit spreads really might be a tinderbox waiting to explode. And that's not my term, by the way. That's a Wall Street term. As anyone knows, levels of complacency that get to this extreme, that's never a good sign. While it's not a timing signal, it tells you that the risks are being heavily mispriced. Like I said, we haven't seen spreads this tight since 2007. I'm talking June, July 2007, just before the crisis began, or in 1998, just before that one started. So where we are in terms of credit spreads, triple B rated spreads, which are not the worst, not the riskiest, they're sort of in the middle of the menu. Those had fallen under 100 basis points on average, according to these calculations, for the first time since 1998, just prior to the worst parts of the Asian not financial crisis. So under 100 basis points, something you don't usually see from triple B rated stuff. And other parts of the market and other spread calculations are following right along with the triple Bs. Bank of America Merrill Lynch's Master 2 index, that one has fallen to around 260 basis points, which is the lowest for this spread area since 2007, right before the crisis. By the way, when we're talking about credit spreads, what we're talking about is the additional yield that the market demands over and above the same maturity U.S. Treasury. In other words, how much additional return premium the marketplace is requiring in order to invest in these riskier debt propositions. So riskier debt, you should have higher return, and the more you perceive that debt is risky, the greater the return you should get. But it's been the opposite direction for the last several years, as we'll get to in this video. Credit spreads have been compressing and compressing and compressing. We'll go over the reason why and why it's starting to spook those on Wall Street. Speaking of spooking those on Wall Street, Bloomberg reported just the other day, price moves in global credit markets are so calm that some money managers are wondering whether a relentless rally in corporate bonds is becoming a red flag, and it really is. A handful, including those at Franklin Templeton Investment Management and AXA Investment Managers, are getting more cautious about corporate bonds. With investment-grade spreads at the tightest in almost 2 decades, they've been reducing allocation to the asset class in favor of government bonds, safety and liquidity, and cash, believing that the meager reward isn't worth the risk. And everyone knows this. Everyone knows it. But since you don't know when everything will turn around, you have to hold your nose and hold your breath and just hope. These managers are going against the crowd. Flows into corporate bond funds have been unremitting, while systemic traders are, quote, max long the asset class, according to UBS Group. And it's not max long, it's max complacency. Everyone is convinced that the small additional return that you get in these riskier assets, it's worth the risk because there is no risk. That's what the complacency is really about. When everybody becomes complacent that everything's just fine, it normally isn't, said David Zahn, who's the head of European fixed income at Franklin Templeton, and truer words have never been spoken. The chances of a policy mistake in multiple jurisdictions is incredibly high. And when you're talking about chances of a policy mistake, he means that central banks have tightened rates too far and held them restrictive too long, and therefore it leads to an economic downturn that was caused by central bank policies. What he's really saying is we think the risk of an economic downturn are too high, and it isn't going to be caused by central bankers, as we've seen the forgot how to grow economy. That's already a downturn, but now we're getting signs that the forgot how to grow economy is becoming more than just forgetting how to grow, as we see an acceleration of the downturn in Europe, loss of momentum in the United States. I'll go over the data we just got in the form of PMIs for the month of February with Steve in tomorrow's video. But also Australia cutting rates because that now one of the strongest economies there are, Australia, suddenly it is forgetting how to grow too. It's not a policy mistake. It's the risk that the downturn becomes the more familiar downturn. Back to Zahn, he said the total return fund that he manages has cut exposure to credit from more than 40% last summer to just under a quarter now, preferring government bonds. The broad-based buying has depressed metrics of volatility, corporate credit volatility, to the point where movements in risk premiums have rarely been as tranquil in recent years. And that's just another level and measure of complacency, that people are not demanding risk, and so there's no volatility in the space apart from last August, simply because people are just waiting for a certain set of triggers. And I'll go over those in just a second, like I said. Volatility on the cost of protection against default among North American investment-grade companies over a rolling 60-day period is close to its lowest level since 2021, when everybody thought the permanent plateau of prosperity from the supply shock. And has been consistently subdued this month based on data compiled by Bloomberg. It's a similar picture for volatility measures on key U.S. and European investment grade indexes and European credit default swaps. It's basically the entire marketplace. I told you about the triple Bs. Also, the triple Cs are experiencing a huge amount of demand as well, which means it's not just the investment grade stuff or the barely sub-investment grade risky corporate assets. It's also the really risky corporate assets. Everybody is convinced that at the current moment in time, everything is priced to Goldilocks. And it sounds a lot like the stock market because there's a lot of commonality between the two marketplaces. Continuing with another report on the same topic, the strong U.S. economy, or the perception of a strong U.S. economy, has left distressed debt investors starved of opportunity, but that may be about to change, at least according to veteran high-yield analyst Marty Fritzen. The distress ratio, which is the proportion of bonds trading at a spread of 1,000 basis points, fell to 3.7% in January, well below the 12.7% historical average, and down from a recent peak of 10.4% in March 2023. So along with the credit spreads that we're talking about here, here's another measure which shows exceptional extreme levels of utter complacency, which is basically what you see right at the top of every cycle, every bubble, everything in finance where it just goes too far. You're not going to see the distress ratio zoom up immediately, but it will go up, said Fritzen. The distress ratio staying low for a protracted period is, quote, a tinderbox waiting to explode, according to Phil Brendel, who's a senior credit analyst at Bloomberg Intelligence. At least that's what he said in a recent podcast. And when you're accepting such little additional premium for risk, it is a sign of absolute complacency. And it's a sign at these levels that we have rarely seen before. That's what's got everyone unnerved. When everyone is on one side of the trade, it's only downhill from there. In this case, not downhill for spreads, it's uphill like we saw last August. Now, what's been driving credit spreads lower to begin with as well as a couple different things, starting with interest rates. Credit spreads exploded higher back in 2022 for a couple of reasons there. One, the economy started to look shaky. It began to forget how to grow, which not exactly the transition that credit investors were looking for. Two, higher interest rates and the prospect for higher for longer meant that in terms of corporate credit, especially risky corporate credit, maybe a lot more firms would be unable to survive a higher interest rate environment. So there was a lot of selling in risky corporate credit. Spreads really soared pretty substantially in 2022. But ever since then, ever since the point that I keep pointing out in October and November 2022, when market interest rates plateaued and then went sideways to lower ever since, Ever since then, the corporate risky credit market has said, well, if interest rates are going to stop rising with central bank rate hikes, then we have a better chance of some of these firms surviving because rates are not going to go higher. It doesn't really matter what the central banks are doing. The market interest rates were steady from late 2022 forward. And if you thought that higher interest rates were the biggest threat to the entire investment space, then the prospect for lower interest rates, or at the very least rates not going higher, means there's less risk or perceived to be less risk for it. At the same time, just like in the stock market, everybody in the corporate credit market, they're looking for the same exact signals. You get out of risky corporate debt the same reason, same time that you get out of stocks, which is when you see anything that looks like the US economy or the global economy is synchronized, is heading into what everyone imagines is a recession. The traditional recession that everyone has in their mind: negative GDP, negative payrolls, an unemployment rate that's rising more than just a few basis points here or there. In other words, you see the economy start to turn around. Just like you get out of stocks, you get out of corporate risky credit. And over the last couple of years, during this forget how to grow regime, it doesn't look like the traditional recession. Because it doesn't look like the traditional recession, it has allowed stocks to continue to soar and corporate credit prices to do the same thing, compressing spreads further and further. But there's also circular reasoning that goes along with that, because you think, even whatever the fundamentals might be, we don't get negative GDP. The lower the corporate credit spreads go, or the higher the stock market goes, the more those markets must be reflecting the fact that everything is just fine. So corporate credit spreads go down because you think the economy's fine, and the economy's fine, which means corporate credit spreads can go down even more. There's more room because there's less risk. It becomes a circular reasoning, all of it based on the lack of appearance for these traditional recession signals. So while the economic fundamentals continue to deteriorate, they're not deteriorating in the specific way that the entire marketplace, corporate credit and stocks, are looking for in order to trigger their selling points. Now, we came close to seeing those last summer, July and into August. That's what the carry trade blowup was really about. Japanese investors who were heavily invested in similar products, CLOs and the like, started to get unnerved by the fact that the labor market data was becoming increasingly negative. And if you've got negative labor market data, chances are that you get the traditional style recession that everyone notices. And if everybody starts to notice these triggers, everybody's going to start selling. That's the thing that's really worrying about from the Wall Street perspective. Everybody knows if these triggers show up, it's going to be a bloodbath across the entire corporate credit market. There's not enough additional return in these low spreads to absorb even the hint, the possibility of a recessionary environment, which is exactly what happened last August. Spreads blew out as the increasingly negative, the increasingly recognizable recession signals really did start to spook a lot of investors. And so early August of 2024, they really sold and spreads soared and spilled over into the stock market. As the BIS even noted in its report on the August 2024 carry trade blowup, it said, investors appeared to reassess the likelihood of a potential recession, with some perceiving the prevailing policy stance, again going back to the Federal Reserve and interest rates, as too tight. No, it was just perceiving the economic fundamentals had shifted toward a more recognizable recession status. In fact, though the news could hardly be taken as unequivocal sign of deteriorating outlook, let alone a looming recession, yet markets had become hypersensitive to any sign of a change in growth momentum. And that's the important part. Hypersensitive to any sign. Hypersensitive because spreads are so low, there's too much complacency, there's not enough return to compensate for any variation. Hypersensitive because everyone is on edge knowing how these cycles play out. As soon as the traditional recession signals show up, the selling is going to get out of control. It's going to hit from all sides, and everyone knows it. They just don't know when. So everyone has sort of a hair trigger because there are red flags all over the marketplace. Everyone knows there's too much complacency, there's not enough risk, but yet you can't afford to stay out of the market and wait for these things to play out. I mean, understandably, the forgot how to grow economy has been going on for nearly 3 years already, and there hasn't been the traditional recognizable sort of recession develop out of it. There has been in a few places, but not nearly enough to provoke that response. And so money managers can't afford to stay out of the space. They have to do so as if they're holding a tiger by its ears. They don't want to be in this position, but they don't have any choice without a dependable timing signal, which nobody, absolutely nobody has. So we've seen this before. In fact, you go back to 2006, 2007, and into 2008. As I referenced before, the Bank of America Merrill Lynch High Yield Master 2 Index, that one, like I said, is down around 260 basis points. Now, it had been 241 basis points. That was the low on June 5th of 2007. So you're talking about just barely 2 months before the full crisis erupted, you have massive near historic levels of complacency in the same corporate credit market. And of course, since from June of 2007 forward, spreads absolutely blew out because everyone was hypersensitive to the triggers back then too, which they started to get more concrete evidence for in the summer of 2007 heading into the fall. We had payrolls that started to become negative, GDP that looked more and more dicey, the entire economic situation on top of the clear signals of liquidity distress, which is a real death knell to any of these risky marketplaces, clear signs of liquidity distress from the summer of 2007 forward. Same thing in the indexes related to triple B rated corporate credit. Those particular spreads, on average, were down around 115 basis points really steadily from 2004 to 2007. So a high degree of complacency up until 2007. And we've got even more of that now, as I pointed out in the introduction. And then the triple Cs, the triple hooks, the lowest rated corporate credit that's out there. You saw spreads compress all the way to 414 basis points by June of 2007. And they had been compressing pretty substantially from the previous fall, September 2006, largely for the same reasons we're getting here today. The idea that the U.S. economy had hit the right plateau after the rate hikes in 2004, 2005, in the middle of 2006, plus the fact that the Fed was now on hold from September 2006 moving forward. And then as the economy continued to evolve, there was the idea that not only was the Fed going to be on hold, they were going to actually lower rates into 2007, maybe into 2008. So spreads were compressing throughout late 2006 and the first half of 2007, right on into the global not financial crisis and the great not recession because of the same types of reasons and behavior. Until the concrete signals showed up, until those specific recession triggers showed up in more frequently in the summer of 2007, everybody just bought, everybody stayed complacent, everybody was still hypersensitive to the swings in the economic cycle, the more recognizable economic cycle. As I said, we've seen a couple of things more recently that suggest after a temporary boost last year for a couple of artificial reasons, including a whole bunch of activity last year that was tied to beating tariffs and price changes. Also, a little bit of euphoria in some places over the Federal Reserve's rate cuts because we're taught to believe and conditioned to believe that rate cuts are huge benefits. So there was a little bit of that. There was some election stuff. So you had a little bit of not quite a boomlet in the economy last year, certainly in sentiment there was. But now we've seen a lot of data that shows and suggests everything really is rolling over January to February. There's a dramatic drop in the PMIs from S&P Global. Like I said, I'll talk about with Steve in tomorrow's video. You got a warning from Walmart, also something we'll talk about with Steve tomorrow. Amazon had already warned. Retail sales that dropped far more than was expected in January. We've got the labor market data. We keep talking about that. Consumer confidence rolled over very sharply from the high last year. Big downturns in January and into February. So you got a whole lot of data that's starting to look a little bit more like it could be moving in the same direction as last August. Therefore, the entire marketplace hypersensitive on edge because of the degree of complacency. Like I said, the problem here is credit spreads, like a whole bunch of these financial indications, they only tell you about perceptions of risk and in some places a contrarian view on them. Like when spreads are so narrow and so complacency is so evident, that's a negative sign. That means that the marketplace is mispricing a whole bunch of stuff. But they don't tell you when. They don't say when credit spreads have gone too far, the market is misdiagnosing the situation. What everybody does is they look for, okay, negative GDP, negative payrolls, that's a recession. I'm out. I'm getting out of everything. And the thing is, as we saw last August, you don't wait around for those signals. If you get the negative GDP or negative payrolls, it's already too late because as hypersensitive as everybody is, they have already sold. That's what really happened last August. But that doesn't mean because we got through August into the end of the year and then started this year that the recession case is off the table. If we learned anything from the forgot how to grow economy and how it shows up everywhere, is that the global economy, while it doesn't look like a recession, continues to deteriorate, which raises the chances of these triggers and these signals that everyone is looking for. It raises the chances that they do show up, because the economy that forgot how to grow is still forgetting how to grow, and everyone is still way too complacent about the risks over it. Yeah, Amazon had already said that the year started out rather weak. Retail sales were not good, and went over both of those in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.